There is a line on your property tax bill that most seniors never notice. It is not hidden. It is not buried in fine print. It is right there, sitting in plain sight, sometimes worth hundreds or even thousands of dollars every single year. And the reason most people miss it has nothing to do with carelessness. It has to do with something much simpler. Nobody told them to ask for it. Property tax exemptions for seniors exist in nearly every state in this country. Some reduce your taxable value. Some freeze your tax rate. Some defer what you owe until your home is sold. And some eliminate a significant portion of your bill entirely. But here is the part that matters most. In the vast majority of states, these exemptions do not come to you automatically. You have to apply for them. And if you miss the deadline, in most cases you lose that protection for the entire year and have to start the process over again. Think about what that means for a moment. A retired couple in their early 70s. They paid off their home years ago. They are living on Social Security and a small pension. Their property taxes have gone up every few years. They have heard the term homestead exemption before. They assumed they were already enrolled because they have owned the home for 20 years. They were not. They never applied. And over the past decade, depending on what state they live in, that oversight may have cost them more than $10,000. That is not a scare story. That is how this system actually works. In this video, I want to walk you through the most important property tax protections that seniors are entitled to, starting with the ones that are easiest to miss and ending with the one that can affect your home and your spouse's financial security for years to come. Stay with me through all of it, because the protection that matters most to your specific situation may not be the first one I mention. Before we get into the list, you need to understand something about the way property tax exemptions are structured in this country. Property taxes are administered at the county or local level. That means the rules, deadlines, application forms, income limits, and benefit amounts vary not just from state to state, but sometimes from county to county within the same state. That is the first reason so many seniors miss these protections. There is no single place to look. There is no government agency that mails you a notice on your 65th birthday and says, "Here are the exemptions you now qualify for." The assumption built into the system is that you will go looking. The second reason is that many seniors believe they are already protected when they are not. A homestead exemption, for example, is available in most states to any homeowner who uses the property as a primary residence. But age-based exemptions in senior-specific programs are separate categories with separate applications and separate eligibility rules. Having one does not mean you have the other. The third reason is timing. Many of these programs have annual deadlines. Miss the deadline and you wait another full year. In some states, the deadline is in the spring. In others, it is in the fall. In others, it is tied to when your assessment notice is issued. If you do not know there is a deadline, you cannot plan around it. And the fourth reason is income limits. Many senior property tax programs are means tested, meaning they are tied to income or asset thresholds. People sometimes assume they earn too much to qualify, or they assume the limit is lower than it actually is, and they never apply. In many cases, the income limits are broader than people expect. So if you have owned your home for years and you are not absolutely certain which exemptions you have applied for and been approved for, this video may be the most financially useful thing you watch this year. Number 7. The basic homestead exemption you may have forgotten to renew. Let us start at the foundation. Most homeowners who have lived in a home for many years are familiar with the homestead exemption. This is the most common property tax protection in the country. It applies to your primary residence and reduces the taxable value of the home by a set amount. But here is something that surprises people. In some states and counties, a homestead exemption does not automatically renew. When a home changes hands, when an ownership title is updated, when a deed is modified, when a trust is created and the home is transferred into it, the existing exemption can be invalidated. And in some cases, the exemption is simply audited every few years and homeowners are required to confirm they still qualify. A retired electrician in his late 60s transferred his home into a living trust on the advice of his estate planning attorney. It was smart planning, but neither the attorney nor the county assessor's office notified him that the transfer triggered a review of his homestead exemption status. The exemption lapsed. His tax bill went up by nearly $1,000 that year. It took 2 more years to fully sort out the paperwork and restore the exemption. If you have ever refinanced your mortgage, updated your deed, added or removed a spouse's name from the title, or transferred your home into a trust, go back and confirm that your basic homestead exemption is still active and still reflected on your assessment record. This is the starting point. Everything above it builds on whether this foundation is in place. Number 6, the Senior Homestead Enhancement. You did not know was a separate application. In many states, the basic homestead exemption is just the floor. Once you reach a certain age, typically anywhere from 60 to 67 depending on the state, you may qualify for an enhanced or additional exemption specifically for seniors. This additional benefit reduces your taxable property value even further, beyond what the standard homestead exemption provides. What confuses people is that in most places this is a completely separate application. It is not automatic. It is not added to your file because you turned the right age. You have to go back to your county assessor or local tax authority and apply specifically for the senior version of the exemption. And the income limits are sometimes more generous than people expect. Some states set the qualifying income threshold at $30,000 per year. Others go higher. A few have no income requirement at all for the age-based enhancement. Think about how many seniors are sitting in their paid-off homes right now, 72 years old, receiving Social Security and a modest pension, paying the same property tax they paid at 60 because nobody told them to go back and apply again after they turned 65. If you are not sure whether your state or county offers a senior enhancement on top of the standard homestead exemption, the first call to make is to your county assessor's office. Ask specifically whether there is an age-based or senior-specific exemption you have not applied for. Number 5, the veteran and disability exemption that stacks on top of everything else. This one matters to a larger group than most people realize. Most states offer property tax exemptions specifically for veterans, and in many cases, those exemptions are substantial. Some cover a percentage of the assessed value. Others reduce the tax bill by a flat dollar amount. In several states, veterans with a service-connected disability rated at 100% by the Department of Veterans Affairs may qualify for a complete property tax exemption. What does that mean? For a qualifying veteran, the entire property tax bill on a primary residence could be eliminated. But even for veterans with lower disability ratings, partial exemptions may be available. And importantly, these exemptions often do not require an income threshold. The eligibility is tied to the service record and disability rating, not to how much money you earn. Here is where it gets more complicated. Many veterans who qualify for these exemptions have never applied. Some did not realize the exemption existed. Some assumed it was only for 100% disabled veterans. Some applied years ago, but when they moved to a new county or a new state, they did not realize they needed to reapply. And there is a separate category worth knowing about. Many states also offer property tax exemptions for homeowners with non-military disabilities. If you're under 65 but have a documented disability, you may qualify for protection that is entirely separate from the standard senior exemption. If you are a veteran, contact your county assessor and ask specifically about veteran property tax exemptions in your state. If you have a disability, ask the same question. Do not assume you do not qualify until you have actually confirmed it with someone who can look at your specific situation. Number 4, the circuit breaker credit that seniors with modest incomes overlook. This one has an unusual name that tends to cause confusion, but the concept is straightforward. A property tax circuit breaker is a protection offered in many states that limits the percentage of your income that you are required to spend on property taxes. When your property tax bill exceeds a certain percentage of your income, the circuit breaker kicks in and provides a credit or refund for the excess amount. Think of it like a pressure release valve. If your taxes become disproportionately large relative to what you are actually earning in retirement, the circuit breaker is designed to provide relief. These programs go by different names in different states. Some call it a homestead credit. Some call it a tax relief program. Some administer it through the state income tax return. Some require a separate application filed with the county. A retired teacher in her early 70s was receiving Social Security and a small pension that together added up to about $28,000 per year. Her property taxes had climbed to nearly $4,000 annually, which represented a significant slice of her income. She had never heard of a circuit breaker program. When her adult son helped her look into it, they discovered she had been eligible for a partial credit for at least 5 years. She could not recover what she had missed in prior years, but going forward, the credit reduced her effective tax burden by several $100s annually. To find out if your state has a circuit breaker program, search your state name followed by property tax circuit breaker or property tax relief for seniors with low income. You can also call your county assessor or your state's Department of Revenue and ask directly. Income limits for these programs vary widely by state. Do not assume you earn too much to qualify before checking the actual threshold. Number 3, the assessment freeze you can lock in before property values rise again. This is one of the most powerful protections available to senior homeowners, and it is one of the least known. A property tax assessment freeze, sometimes called a senior freeze or a senior valuation protection, locks the taxable assessed value of your home at the level it was when you enrolled in the program. Even if your home's value increases substantially in the years after you enroll, your property tax bill continues to be calculated based on the frozen value. This is a very different protection from a standard exemption. An exemption reduces your value by a fixed amount. A freeze stops your value from growing any higher than it was on a specific date. In a real estate environment where home values have climbed significantly over the past several years in many parts of the country, this protection can mean the difference between a tax bill that stays manageable and one that climbs every year alongside the market. Here's a realistic example of how this matters. Consider a couple who retired 10 years ago in a modest home assessed at $200,000. If that home is now assessed at $350,000 and the local tax rate is 1.5%, that assessment increase alone represents an additional $2,250 per year in taxes on top of what they were already paying. An assessment freeze, had they applied when they first qualified, would have prevented that increase entirely. Most states that offer assessment freezes require you to meet an age threshold, typically 60 to 65, and in many cases an income threshold as well. And like all of the protections on this list, the freeze generally does not apply automatically. You have to apply, and in many states you have to apply before a specific deadline each year. Once enrolled, some states require annual renewal. Others are one-time applications. Confirm which applies in your state so you do not accidentally lose the freeze by missing a renewal deadline. Number 2. The tax deferral program your spouse may desperately need after you are gone. Now we are getting to the part that most families do not think about until the moment it becomes urgent. A property tax deferral program allows a qualifying senior homeowner to postpone paying property taxes until the home is sold, transferred, or the owner passes away. The taxes do not disappear. They accumulate with interest, but they are not due while the senior is living in the home. This is not an exemption. It is a deferral. The county essentially places a lien on the home for the deferred taxes, which are repaid when the property changes hands. But here is why this matters so much, especially for couples. Imagine a widow in her late 70s. Her husband managed all the finances for 40 years. He passed away 2 years ago. Between his pension ending and her reduced Social Security survivor benefit, her income has dropped significantly. She owns the home outright, but her property tax bill is now the single largest fixed expense she faces each month. A tax deferral program could allow her to stop paying that bill entirely for the rest of the time she lives in the home. When the home is eventually sold or transferred to her children, the deferred taxes and interest are paid from the proceeds. This does not make sense for everyone. If your home equity is your children's primary inheritance, the interest accrual on deferred taxes could reduce what they receive. That is a real trade-off, and it deserves a conversation with a qualified professional before you decide anything. But for seniors who are cash flow constrained, who have meaningful home equity, and who are not primarily concerned with passing the home to the next generation, a deferral program can provide genuine month-to-month financial relief. Many seniors who would benefit from this program have never been told it exists. Many states offer it, and it goes largely unused because nobody applies. If this situation resonates with you or with a parent you are helping, search your state's name followed by property tax deferral for seniors, or call your county assessor and ask directly whether a deferral program is available and what the eligibility requirements are. Number 1. The deadline you cannot miss and the form you have never been mailed. Here is the most important part of everything we have covered today, and it is the one that can make every other protection on this list meaningless if you overlook it. Every single program I have described has a deadline, not a suggestion, not a guideline, a hard deadline. Miss it, and in most cases you forfeit the benefit for that entire year. You do not get a grace period because you did not know. You do not get a credit for the prior year because you applied late. The system does not send reminders. It does not notify you when a new exemption has been created that you might qualify for. It does not reach out when your income drops in retirement and a circuit breaker program suddenly applies to your situation. The application burden sits entirely on the homeowner. What makes this even more complicated is that different programs within the same county sometimes have different deadlines. Your basic homestead exemption may have a deadline in April. Your senior enhancement may have a different deadline in March. Your circuit breaker credit may be filed through your state income tax return with a deadline in the spring. Your assessment freeze may need to be filed in the fall for it to take effect the following year. Now add to that the reality that many senior homeowners are managing health issues, a spouse's illness, changing living situations, transitions to part-time care, or simply the normal challenges of organizing paperwork in a stage of life when there is less margin for administrative complexity. This is how eligible seniors miss years of protection. Not through carelessness, through a system that requires them to find, understand, apply for, and in some cases annually renew protections that nobody proactively explains to them. Here is what you can do right now. Contact your county assessor's office. Most have websites that list every available exemption program for your county, along with the deadlines and the application forms. Ask them directly, what senior property tax exemption programs do you offer? When are the deadlines? And can you tell me which programs are currently on file for my property? That last question is important. Ask what is on your record, not what you think you applied for. Not what you remember doing. Ask what the county actually has on file for your address. Because sometimes applications that were filed years ago are not reflected in the current record. And sometimes people believe they enrolled in a program they actually never completed. If you have an adult child who helps you manage paperwork, this is exactly the kind of task worth asking for their help on. A single phone call or a visit to the county assessor's website could identify thousands of dollars in annual savings that have been sitting there unclaimed. Let me give you a clear and practical list of what to do after watching this video. The first step is to pull your most recent property tax bill or assessment notice. You want to see exactly what exemptions are currently applied to your account. Your bill should list any active exemptions by name. If you see nothing listed, that is worth investigating. The second step is to go to your county assessor's website or call their office and ask for a complete list of senior-specific property tax exemption programs available in your county. Ask for the deadlines for each one. Ask what documentation is required to apply. Many counties list this information clearly on their websites and even provide downloadable application forms. The third step is to verify the programs you believe you are already enrolled in. Do not assume. Ask the assessor's office to confirm which exemptions are currently active on your property. Request this in writing if you want a clear record. The fourth step is to check whether your state offers an assessment freeze program for seniors. If it does, find out the income and age requirements, the application deadline, and whether it requires annual renewal. If you qualify, apply before the deadline. The fifth step is to ask about a tax deferral program if your monthly cash flow has become strained. If your property taxes are creating financial pressure and you have significant equity in your home, a deferral program may provide real relief. But before enrolling, discuss the long-term implications with a tax professional or financial advisor who can help you understand how deferred interest could affect your estate. The sixth step is to mark the deadlines on a calendar and set a reminder. Property tax exemption deadlines are not automatically sent to you. You have to track them yourself. If you apply this year and get approved, note when any renewal is required. Losing a protection simply because you forgot to renew is entirely preventable. The seventh step is to check whether a veteran's exemption applies to your household. If you or your spouse served in the military, contact your county assessor and the County Veteran Services Office and ask specifically about property tax exemptions tied to military service or service-connected disability. And the eighth step is this. If your parent or older family member owns a home, consider helping them make one phone call to their county assessor's office. It costs nothing. It takes 20 minutes, and it could uncover protections they have been entitled to for years without knowing it. Do not make any permanent changes to your deed, trust, or title documents without first checking whether those changes could affect your existing exemptions. In some cases, estate planning steps that are otherwise sound can accidentally trigger a review or loss of exemption status. Make sure whoever is helping with your estate plan is also aware of your property tax exemptions. Let me bring this together. Property tax exemptions for seniors are real, substantial, and widely available. They include senior enhancements to the standard homestead exemption, circuit breaker credits for lower-income homeowners, assessment freezes that lock your taxable value in place, veteran and disability exemptions, and deferral programs for homeowners who need monthly cash flow relief. None of these come automatically. Every one of them requires you to apply. Most of them have annual deadlines that nobody is required to tell you about. The risk is not that these programs do not exist. The risk is that eligible seniors spend years, sometimes decades, paying more than they are legally required to pay simply because they did not know to ask. You now know to ask. Confirm what exemptions are already on file for your property. Find out what you qualify for that you have not applied for yet. Mark the deadlines. And if your situation involves a spouse or aging parent, make this a shared conversation. Your home is one of the most significant financial assets in your retirement. Protecting it means more than just keeping up with the mortgage or knowing your home insurance is current.
It means understanding every legal protection the tax system offers you and making sure you have claimed every one of them.
If you found this helpful, I want to ask you to do one thing right now. Comment the word exemptions below this video. When you do, I will know you want more content on protecting your retirement money and your home, and I will make sure we cover more of these topics in the weeks ahead. If you are not sure which programs apply in your specific state or county, I am working on a follow-up video that breaks this down region by region. So make sure you are subscribed so you catch that when it comes out. And if there is someone in your family, a parent, a sibling, A neighbor you know who owns their home and is living on a fixed income. Please share this with them. A single phone call to the county assessor's office could change their tax bill for years to come. That is the kind of information that deserves to be passed along. Take care of your home. Take care of your family. And do not leave money on the table that was always meant to be yours.